The best way to understand the Republican tax bill is not to start with the slogans. Start with the expiration dates. That is where the game gives itself away. Republicans talked about tips, overtime, seniors, car loans, and now Trump accounts for children. Each one sounds friendly. Each one sounds like help for ordinary families. That is why the sales pitch works. The IRS says the deductions for tips, overtime, car loan interest, and seniors generally apply from 2025 through 2028. The $1,000 Trump account pilot contribution is also limited to eligible children born from January 1, 2025, through December 31, 2028. That date matters. When worker-facing tax cuts expire after 2028, they can be sold now and dangled again later. Elect us again or the tax break disappears. That is not serious tax policy. That is campaign leverage. The parts of the bill Republicans talk about most are the parts with expiration dates. Tips, overtime, car loans, seniors, and newborn accounts all make good campaign material. But they are not built to last. The business and wealth provisions are treated differently. Corporations, business owners, large estates, and capital income get certainty. Workers get a countdown clock. That contrast is the whole story. The Trump account is the perfect political prop. $1,000 for a newborn is better than nothing. Families should take it if they qualify. But the benefit is limited to a 4-year birth window. A baby born in 2028 may qualify. A baby born in 2029 does not. Apparently, the American dream comes with terms and conditions. A long-term investment account may help someday. But it does not solve what families face when a child is born. It does not lower childcare costs. It does not protect Medicaid. It does not put food on the table next week. Families with extra income can keep contributing. Families with stable jobs, employer benefits, and financial advisors can turn a small public seed into a larger private advantage. Families living paycheck to paycheck may have no extra money to add. That is how inequality hides inside a universal-looking benefit. A deduction does not raise wages. It does not require employers to pay more. It does not provide health insurance. It does not guarantee full-time hours. And it may do little for workers who already owe little or no federal income tax. The Center on Budget and Policy Priorities reports that the tipped income deduction will benefit fewer than 3% of households, and the overtime deduction fewer than 9%. The Congressional Budget Office estimates the law will increase the federal deficit by $3.4 trillion from 2025 through 2034. That comes from $4.5 trillion in revenue losses, partly offset by $1.1 trillion in direct spending cuts. CBO later estimated that debt service costs would add $718 billion, bringing the cumulative deficit effect to $4.1 trillion. That is the part the slogans are supposed to hide. Temporary tax breaks for workers, larger long-term benefits for wealth, and future pressure on programs families depend on. The tax breaks are real, but the pattern is the point. The worker tax cuts are the shiny object. The shell game is that they expire while the tax cuts for wealth are built to last. Tax cuts for workers sunset. Tax cuts for wealth do not. Follow the money.